Fed rate hike is here. Is gold, cash, or stocks the smartest bet now? Introduction. When the Federal Reserve raises interest rates, the financial world holds its breath. Investors scramble for safe havens, uncertain whether to double down on the US dollar, hoard gold, or ride out the storm in equities. But what if this rate hike isn't just a routine policy move? What if it's the turning point that defines the next decade of your wealth? In today's episode of Bold Steps Forward, we dig into what history, market signals, and smart money are telling us. Should you hold your cash and wait? Or is now the time to buy gold or tech stocks before the window closes? Stay tuned, because by the end of this story, you'll know where the real opportunity lies. Backhand index pointing right. Don't forget to like, subscribe, and share this video if you want to stay ahead of every major financial shift. Chapter 1. What happens when the Fed hikes rates? Every time the Federal Reserve announces a rate hike, Wall Street reacts. Sometimes with panic, sometimes with euphoria. But for investors watching from the sidelines, the question remains. What exactly does it mean when the Fed raises interest rates, and how does it impact your money? Let's break it down. Understanding the Fed's strategy. At its core, the Federal Reserve raises rates to combat inflation and cool down an overheating economy. When borrowing becomes more expensive, consumer spending slows, businesses scale back investments, and the overall pace of economic growth moderates. That's the theory. But the financial world is far more complex. When the Fed lifts its benchmark rate, the federal funds rate, it triggers a chain reaction. Banks increase lending rates, making mortgages, car loans, and credit cards more expensive. Bond yields rise, especially on short-term treasuries, creating competition for investor capital. The US dollar strengthens as foreign investors seek higher returns in dollar-denominated assets. Stock market valuations adjust as future cash flows are discounted more heavily. But the timing and magnitude of these effects vary widely depending on how markets interpret the Fed's intentions. How markets react. A look at history. Let's rewind to 2004 to 2006, when the Fed steadily raised rates from 1% to 5.25%. The S&P 500 actually climbed during that period, until the housing bubble burst, revealing that the tightening cycle had masked deeper systemic risks. In contrast, during 2015 to 2018, the Fed's gradual rate increases followed a long recovery from the 2008 crisis. Stocks remained strong, and volatility stayed relatively low, until late 2018, when the Fed hinted it might go too far, too fast. The result? A sharp correction. Most recently, in 2022, the Fed embarked on its most aggressive hiking cycle in 4 decades. Interest rates jumped from near zero to over 5% in just 18 months. Initially, markets sold off sharply. Tech stocks were hammered. But by late 2023, as inflation cooled and earnings stabilized, investors started buying back in, betting the worst was over. The first domino, bonds and yields. The bond market is the first place to look after a rate hike. Rising interest rates mean falling bond prices. Because existing bonds with lower yields become less attractive compared to newly issued bonds with higher returns. But higher yields also attract conservative investors. When 10-year Treasury yields climb above 4%, some market participants shift from riskier assets like stocks into these safer instruments. This movement can drain liquidity from equities and pressure stock prices, especially in sectors dependent on cheap capital like tech and real estate. Currency strength. The dollar dominates. One lesser-known impact of a Fed hike is its influence on global currency markets. A higher interest rate makes the US dollar more attractive to international investors. Capital flows into the US, strengthening the dollar against other currencies like the euro, yen, or emerging market currencies. While a strong dollar might sound good, it's a double-edged sword. It hurts US exporters, making American goods more expensive overseas. It lowers commodity prices, like oil and gold, since they're typically priced in dollars. It pressures developing economies, as their debt becomes harder to repay in stronger USD terms. So, a rising dollar might signal confidence, but also carries risk. Stocks under pressure, but not equally. Not all stocks react the same way to interest rate hikes. In fact, some thrive. Growth stocks, particularly in tech, often take a hit. These companies depend on future earnings, and as rates rise, those future profits are worth less in today's terms. Financials like banks and insurers may benefit from higher interest margins. Value stocks, think energy, industrials, and utilities, often hold up better, especially if the rate hike environment is accompanied by strong GDP and consumer demand. Timing also matters. Stocks may initially dip after a rate hike but rebound as investors realize that the underlying economy remains strong. Inflation expectations, the hidden variable. Here's the twist. What really drives market sentiment isn't just the rate hike itself, it's what the Fed says next. If the Fed signals that more hikes are coming, or that inflation is still out of control, investors may brace for tighter conditions. But if the Fed suggests it's nearing the end of the hiking cycle, or even hints at a potential pause, markets often rally. Because clarity reduces uncertainty, and investors can start planning their next moves. In other words, the expectation of policy is often more powerful than the policy itself. So, what should you watch? To understand the real impact of a Fed rate hike, focus on these indicators. Bond yield curves. A flattening or inverted yield curve can signal recession fears. Dollar strength. Keep an eye on the DXY index and global FX markets. Sector rotation. Track where institutional money is flowing. Are they exiting growth stocks or piling into energy and financials? Fed commentary. Watch Jerome Powell's words closely. Markets hang on every phrase. Closing this chapter, more than just a hike. A Fed rate hike isn't just an economic tool, it's a signal. It reflects confidence in growth, a commitment to fighting inflation, and a warning shot for investors taking too much risk. The effects ripple across every asset class, from gold to tech stocks. But here's the key. Those who understand the patterns, position themselves early, and stay calm when others panic are often the ones who come out ahead. In the next chapter, we'll dig deeper into gold, often seen as the ultimate safe haven. But is it really the best hedge in this environment? Stick around to find out. Chapter 2, Gold, Timeless Hedge or Overhyped Asset. For centuries, gold has carried a mythic status, a symbol of stability, power, and protection against chaos. When markets tremble, inflation spikes, or governments wobble, investors instinctively turn to this shiny metal. But as the Fed raises interest rates and the financial landscape shifts, many are asking, is gold still the ultimate hedge, or has it become a relic of old-world thinking? Let's explore the logic, the data, and the psychology behind gold investing in today's rate hike environment. Why gold? The emotional safety net. Gold isn't just a commodity, it's a belief system. Unlike fiat currencies, gold isn't printed. It doesn't rely on central banks or governments. It can't be devalued overnight by political decisions. That alone makes it attractive during uncertain times. Gold plays a unique psychological role in investing. When fear rises, whether from inflation, war, currency debasement, or recession, people want something real. And gold, with thousands of years of human history behind it, fits that need perfectly. But emotional security isn't the same as financial performance. So let's turn to the numbers. How gold performs during rate hikes. Conventional wisdom suggests that gold struggles when interest rates rise. That's because gold doesn't produce yield, no dividends, no interest. So when the Fed increases rates, assets that do generate income, like bonds, become more attractive by comparison. But reality is more nuanced. Take a look at the data. 2004 to 2006. As the Fed raised rates from 1% to over 5%, gold climbed from around $400 per oz to over $700 per oz. But inflation expectations and geopolitical tensions supported demand. 2015 to 2018, another round of rate hikes. Gold was volatile but mostly flat. Strong dollar strength capped gains. 2022 to 2023, the Fed's aggressive hikes led to mixed results. Gold dipped early but surged later as recession fears mounted and bank instability spooked markets. The takeaway? Gold doesn't always fall when rates rise. In fact, when rate hikes signal deeper economic stress, gold can thrive, even if yields are higher elsewhere. The inflation connection. Gold's reputation as an inflation hedge is well-deserved, but also misunderstood. Yes, gold soared during the 1970s stagflation, climbing over 1,000%. And during the COVID-19 stimulus boom, gold hit new highs in 2020 as inflation fears spread. But in the long run, gold has had mixed results against inflation. From 1980 to 2000, inflation steadily eroded purchasing power, but gold lost value. From 2011 to 2015, gold fell nearly 40%, despite ongoing money printing and central bank easing. But because gold prices are influenced not just by inflation, but by expectations. If markets believe the Fed can control inflation, gold demand weakens. But if confidence in central banks drops, gold surges. So in today's environment, where trust in monetary policy is fragile, gold could gain regardless of interest rates, especially if inflation proves stickier than expected. Who's buying gold right now? It's not just retail investors driving demand. In recent years, some of the world's largest financial players have been quietly accumulating gold. Central banks, especially from emerging markets like China, Russia, and Turkey, have been buying at record levels. But to reduce dependence on the US dollar and diversify reserves, billionaires like Ray Dalio and Stanley Druckenmiller have repeatedly warned about fiat currency risks and positioned parts of their portfolios in gold. Even institutional hedge funds, traditionally wary of gold's volatility, are allocating to precious metals in response to debt concerns and currency instability. In short, the smart money is not ignoring gold. Digital gold. Is Bitcoin replacing the metal? Some younger investors argue that Bitcoin is the new gold. It's decentralized, limited in supply, and portable across borders. In recent years, both gold and crypto have attracted similar audiences, those worried about inflation, systemic risk, and central bank overreach. But there's a key difference: volatility. While gold is relatively stable, Bitcoin can swing 10% in a single day. That makes gold a more trusted hedge for conservative or institutional investors, at least for now. Still, the rise of digital assets hasn't killed gold. It has simply expanded the toolkit for those looking to hedge against fiat and financial instability. Risks of holding gold. Gold isn't a perfect asset. Here are some key drawbacks. No yield. In a rising rate world, that's a big opportunity cost. Storage costs. Physical gold must be securely stored and insured. Tax inefficiency. In the U.S., gold is taxed as a collectible, up to 28% capital gains. Volatility in sentiment. Gold can underperform for long periods when optimism returns or rates stabilize. In other words, gold may protect, but it doesn't always grow your wealth. When does gold shine brightest? Gold tends to outperform in the following scenarios. Negative real interest rates, when inflation exceeds nominal rates. Currency devaluation or loss of confidence in fiat. Geopolitical risk or war. Equity market stress or recession fears. If you believe any of those risks are rising, and many are, then a strategic allocation to gold may make sense. Conclusion: gold's role in a rising rate world. So, is gold still a smart play? The answer isn't binary. Gold is not a growth asset, but it's a store of value when trust in other assets declines. In a world where central banks are hiking aggressively, debt is ballooning, and inflation remains stubborn, gold still has a seat at the table. It may not beat the S&P 500 during bull runs. But when fear returns, gold has a way of reminding the world why it survived every empire, every crash, and every currency collapse in human history. In the next chapter, we'll shift from stability to strength, the US dollar. With rising rates pushing it to new highs, is cash finally king again? Or is holding dollars just a slow way to lose purchasing power? Let's find out. Chapter 3. The US dollar king in a crisis? When uncertainty grips the global economy, one asset consistently stands tall, the US dollar. Often seen as the bedrock of financial stability, the dollar doesn't just represent American economic strength. It represents global confidence. But as the Federal Reserve aggressively raises interest rates, the dollar's dominance is being tested in new ways. Is holding cash now a smart, defensive strategy? Or is it just a comfortable trap in disguise? Let's unpack the mechanics, the history, and the hidden risks of going heavy on the greenback. The mechanics: why the dollar gets stronger when rates rise. It's simple market logic. When the Federal Reserve increases interest rates, yields on U.S. assets rise. That attracts foreign investors looking for higher returns on safe assets, primarily U.S. Treasuries. But to buy these assets, they need dollars. That surge in demand pushes the dollar higher. The result? A strong dollar that dominates global trade, commodities, and cross-border capital flows. In fact, during the Fed's most aggressive rate hike cycle in 2022 to 2023, the U.S. dollar index, DXY, surged to a 20-year high. For a time, the dollar felt invincible. But strength can be deceiving. The pros of holding USD in a rate hike environment. Liquidity is power. In times of market stress, nothing beats the flexibility of cash. It lets you wait, watch, and strike when opportunities emerge. Deflationary pressure. A stronger dollar makes imports cheaper and can reduce inflationary impact domestically. Safe haven in crisis. Historically, the dollar strengthens during global downturns. COVID-19, 2020, the European debt crisis, 2011, and the Great Financial Crisis, 2008, all saw massive capital flows into USD. Short-term capital preservation. When markets are volatile, holding USD is a way to limit downside without moving into riskier assets. So yes, there are moments when cash isn't just king, it's the whole kingdom. But here's the catch, the hidden cost of holding cash. While cash feels safe, It quietly erodes your purchasing power, especially when inflation remains above interest rates. Even at 5% or 6% interest, if inflation is running at 4% or higher, your real return is minimal. Worse, most retail savings accounts still offer rates far below Treasury yields. Holding too much USD during inflationary cycles can be like watching your wealth melt slowly, dollar by dollar. And in the long run, cash rarely builds wealth. It preserves, but it doesn't grow. Global consequences of a strong dollar. The dollar doesn't just impact U.S. investors. It reshapes the global economy. Emerging market pain. Countries with dollar-denominated debt suffer as repayment becomes more expensive. Many face capital outflows, currency depreciation, and rising inflation. Commodity price shock. Since most global commodities, oil, metals, wheat, are priced in dollars, a strong USD often means weaker commodity demand and falling prices, hurting producers. Trade deficits. A strong dollar makes U.S. exports more expensive, weakening trade competitiveness, especially for manufacturers. Ironically, while the dollar strengthens during Fed hikes, it can sow the seeds of global instability, which eventually boomerangs back to the U.S. economy. Cash versus short-term treasuries. A smarter way to hold dollars. Not all dollar-based holdings are equal. Instead of parking money in a savings account, sophisticated investors often rotate into short-term U.S. treasuries or high-yield money market funds, which offer higher interest rates, are backed by the U.S. government. Maintain liquidity. This strategy allows investors to ride the interest rate wave without exposing themselves to long-term bond price volatility. During the 2023 to 2024 market turbulence, many institutional players moved into 3-month and 6-month T-bills, earning 5% plus returns while sitting in cash equivalents. It was safety with yield, a powerful combination. What does history say? When the dollar peaks, history tells us the dollar doesn't stay dominant forever. In 1985, the dollar was so strong it triggered the Plaza Accord, where global powers intervened to weaken it. In 2002, after a long bull run, the dollar began a multi-year slide as deficits ballooned and investor confidence waned. In 2023, many analysts warned that the dollar's strength could eventually reverse as de-dollarization trends emerged and central banks diversified into gold, yuan, and crypto. Bottom line, when the Fed pauses or cuts rates, the dollar often retreats, and that's when other assets start to outperform. Cash is a tool, not a strategy. Many retail investors make the mistake of thinking cash is a safe long-term investment. It isn't. Cash is a bridge between decisions. It gives you optionality, protects during chaos, and preserves dry powder for moments when real assets are on sale. But holding too much for too long means missing the compounding power of equities, real estate, or even inflation-linked bonds. Smart investors treat cash like a temporary position, not a permanent plan. Conclusion: when the dollar reigns, and when to let go. The US dollar may be the strongest currency in the world, but strength has context. In a rising rate world, it offers safety, flexibility, and global demand. But it also brings risks: lost purchasing power, reduced returns, and limited growth potential. If you're nervous about market volatility, holding some USD or short-term treasuries makes sense. But don't mistake calm for opportunity. The real gains often come after the rate hikes end. When markets rebound, assets are undervalued and fear fades. Next, we'll explore the riskiest, but potentially most rewarding, play in this environment: stocks. With rate hikes rattling tech, banks, and real estate, is this the time to exit? or a rare moment to buy when everyone else hesitates? Let's find out in the next chapter. Chapter 4. Stocks, Opportunity or Trap in a High-Rate World. When the Federal Reserve raises interest rates, Wall Street listens and often panics. The logic seems simple. Higher borrowing costs mean lower profits, tighter consumer spending, and falling valuations. So, should you abandon stocks when rates go up? Not so fast. The stock market isn't one single entity. It's a complex ecosystem of sectors, narratives, and expectations. While higher rates can create headwinds, they also expose mispriced opportunities, and investors who know where to look can turn uncertainty into serious gains. Let's break down the truth about stocks during Fed rate hikes, without the noise. The conventional wisdom: higher rates, lower stocks. Interest rates influence the stock market in several key ways. Higher borrowing costs. Companies face more expensive debt, especially in capital-intensive industries like real estate, utilities, and industrials. Lower valuations. Discounted cash flow models use interest rates to determine present value. As rates rise, future profits are worth less, pulling down stock prices. Consumer pressure. As credit card, mortgage, and auto loan rates rise, consumers cut spending, hurting retail, travel, and discretionary sectors. All of this sounds bearish. But here's the twist. The market prices in expectations, not just reality. If everyone expects pain, and that pain is already priced in, surprises can trigger powerful rallies, even during rate hike cycles. Historical patterns. Do stocks always fall when rates rise? Surprisingly, looking at the last 11 Fed rate hike cycles since the 1950s, the S&P 500 rose during 8 of them. But because rate hikes often occur during economic expansions, when companies are still growing earnings, even if financing becomes more expensive. Let's highlight a few examples. 2004 to 2006. The Fed raised rates from 1% to 5.25%. The S&P 500 gained over 30% during that period. 2015 to 2018. The Fed slowly raised rates, and stocks climbed steadily as tech earnings exploded. 2022 to 2023. While the market dropped initially, sectors like energy, defense, and certain value stocks outperformed dramatically. The message? Context matters. What sectors struggle during hikes? Not all parts of the market are equal. Some sectors are more vulnerable in a high-rate environment. Tech and growth stocks. These rely heavily on future earnings, which get discounted more harshly as rates rise. That's why the Nasdaq tends to be hit hardest early in a hike cycle. Real estate. REITs' higher mortgage and financing costs pressure both commercial and residential property values. Consumer discretionary. Think retailers, automakers, travel. Anything dependent on easy consumer credit feels the squeeze. But weakness creates opportunity for the patient and strategic investor. Winners in a high-rate world. Certain sectors actually benefit or stay resilient during rising rate periods. Financials. Banks can earn more from interest spreads, especially when short-term rates rise faster than long-term ones. Think J.P. Morgan, Bank of America, regional banks with strong deposit bases. Energy and commodities. These sectors are driven by global supply and demand, not just interest rates. In fact, commodity shortages can drive inflation, helping firms in oil, gas, and mining. Defense and industrials. Government spending often increases during geopolitical uncertainty, supporting these industries even as borrowing costs rise. Value stocks. Companies with strong cash flows, low debt, and steady dividends outperform flashy growth names in high-rate periods. Think old-school industrials, consumer staples, and healthcare. Dividend aristocrats. In an era of bond-like returns, reliable dividend payers become attractive alternatives to fixed income. In short, investors who pivot from speculation to fundamentals thrive during Fed hiking cycles. What the smart money is doing. Follow the big players. Hedge funds like Bridgewater and Greenlight Capital have rotated into inflation-resilient equities. Warren Buffett's Berkshire Hathaway added more to energy, healthcare, and consumer staples during 2022 to 2023 volatility. Pension funds and endowments are reallocating toward defensive equities and international markets where valuation is more compelling. These moves reflect a core strategy. Don't exit equities, adjust your exposure. The psychology of a rate hike market. Rate hikes test investor psychology more than spreadsheets. When the Fed raises rates, investors fear recession. When inflation persists, investors fear margin compression. When both happen, investors panic, and that's often where generational buying opportunities emerge. History shows that the best buying moments often occur when fear peaks and sentiment bottoms. That's when the strongest businesses trade at rare discounts. Investing strategy: how to navigate stocks during Fed hikes. Here's a practical roadmap. Trim over-leveraged growth plays. Avoid companies that rely on cheap debt or aggressive future projections. Build positions in cash flow positive businesses. Focus on companies with fortress balance sheets. Use dollar cost averaging. Don't try to time the bottom. Spread your investments over time. Watch the Fed's tone. Markets often rally before the final rate hike, not after. The pivot usually marks the turning point. Balance offense and defense. Own a mix of cyclicals, for upside, and defensives, for stability. Remember, it's not about being fearless. It's about being rational when others are emotional. Conclusion: stocks are volatile, but they're still the engine. Stocks are risky. They swing, they drop, they shake investor confidence. But over the long term, no other asset class has created more wealth, innovation, and opportunity. In a high-rate world, the rules change, but the opportunity doesn't vanish. It just shifts. The key is knowing where to look, how to stay disciplined, and when to act while others hesitate. If you're investing during Fed tightening, this isn't the time to run. It's the time to sharpen your focus and find the sectors and stocks positioned to thrive in the new normal. In the final chapter, we'll tie everything together. What's the smartest move today? Gold, cash, or stocks? Or is the real answer somewhere in between? Let's wrap this up. Chapter 5. The Smart Investor's Playbook in a High-Rate World. The question we started with is simple, but the answer is far from black and white. In a world where the Fed is raising rates, should you buy gold, hold cash, or invest in stocks? After 4 deep dives, one truth is clear: there's no single safe choice, only smart positioning. Each asset, gold, USD, and equities, has its moment. But winning in this environment isn't about picking one. It's about understanding the timing, strategy, and balance behind each option. Let's tie everything together and reveal the smartest playbook for this Fed-driven era. Gold, the quiet survivor. Gold is not flashy. It doesn't generate cash flow. It doesn't innovate or grow. But when fear runs high, when central banks lose credibility, and when inflation bites deeper than expected, gold shines. If you believe the Fed may lose control of inflation, or if geopolitical risk is rising, or if long-term debt concerns threaten dollar stability, then gold is not just a hedge, it's an insurance policy. Strategic allocation tip. 5 to 10% of your portfolio in physical gold or ETFs like GLD provides a solid inflation and chaos hedge. But don't overcommit. Gold can underperform for years. It protects, but it rarely leads. Cash, the weapon of patience. Cash isn't sexy, but it's powerful in the right hands. When rates rise, holding USD, especially in short-term treasuries or money market funds yielding 5% plus, lets you preserve capital, wait out volatility, strike when others are forced to sell. But cash is also a melting ice cube. Inflation erodes purchasing power, and the Fed may not keep rates elevated forever. Strategic allocation tip. Keep 10 to 20% in cash equivalents during uncertainty. Rotate into real assets once fear peaks and the Fed pivots. Cash buys time, but you need a plan for redeployment. Stocks, the engine of long-term wealth. The market may wobble during rate hikes, but history shows that equities, especially strong, cash-generating companies, bounce back hard when cycles end. If you only play defense, you miss the upside. If you panic at every headline, you lose compounding. Even in a high-rate world, smart stock investors win by focusing on value over hype, diversifying across sectors and geographies, staying disciplined with entry points. Strategic allocation tip. Gradually rotate into quality stocks in sectors like healthcare, defense, energy, and financials. Use dollar cost averaging to manage risk. When others are paralyzed, bold steps forward create the biggest gains. The smartest move? A tactical combination. No one asset class wins in every scenario. That's why the smartest investors don't bet everything on one horse. Here's a sample diversified playbook for a high-rate, uncertain world. 10% gold, hedge against chaos, inflation, and long-term currency debasement. 15% cash/cash equivalents, liquidity buffer, T-bills, high-yield money markets. 50% equities, focus on value, dividend payers, defensive growth, and select global exposure. 15% bonds, short duration to reduce interest rate risk. Tips for inflation protection. 10% alternatives, optional, real estate, commodities, or crypto for advanced investors. This isn't about prediction. It's about resilience and adaptability. The secret most don't tell you. Most people wait for certainty to invest. They want a signal, a green light, a perfect moment. But here's the truth. You rarely get clarity until the opportunity is gone. The market bottom in March 2020? It looked like the world was ending. The Fed pivot in 2009? Most people were still in fear mode. The best days often come right after the worst news. The real secret is to build your strategy before the sentiment changes, not after. This is the kind of thinking that separates long-term builders of wealth from emotional, reactive investors who chase the trend too late. Final thoughts. Bold steps forward, even in uncertainty. The Fed's rate hikes are a signal, a warning, but also an opportunity. They warn of tightening conditions, slower growth, and inflated risks. But they also open the door for smart, disciplined investors to reposition, rebalance, and profit from dislocation. If you've followed this story to the end, you already understand something most don't. Wealth isn't created in calm markets. It's created when chaos meets clarity. So ask yourself, are you reacting to headlines or planning around cycles? Are you hiding in fear or hunting for asymmetric opportunity? Are you guessing or following a tactical blueprint? The future belongs to those who move forward with clarity, courage, and strategy. Subscribe to Bold Steps Forward, Because we're not just reporting stories. We're building the mindset and the moves that turn uncertainty into advantage. Your next smart investment isn't just an asset. It's knowledge and execution. Stay bold, stay sharp, and keep moving forward.